in a way, that conversion from gold being the main store of value to Bitcoin becoming digital gold, and therefore the main store of value, I think it's unmistakable, right? And I think with gold, there will be continuing supply. It's also interesting that gold has some sort of use case, right? Which actually makes it a lot less pure as a store of value. People mention it as a positive, like at least gold you can use for something. In my view, it's much better for it to be pure as opposed to having that sort of use case. We are seeing just increasing adoption of Bitcoin. So, ask me where is this financial system going to go 5, 10, 15, 50 years from now? It's only one way for Bitcoin.
Welcome to the Bitcoin for Corporations show. Today I'm joined by Khing Oei from Treasury in Amsterdam. King, how are you?
I'm good. Thanks for having me on the show.
Of course. We're also joined by our producer, Spencer Nichols. Spencer, how are you?
Doing swell as well. Thanks for having me.
So first, I want to start with a congratulations for King completing kind of the phase one of Treasury. I'd love to dig into that before we really get into your background. But yeah, that was a really great announcement you had.
Yeah, thank you. We're super excited. We basically announced a couple of things. We announced our investment round, which was founder-led, backed by the Winklevoss twins and David Bailey Nakamoto, and also all three are on our advisory board. Then we announced a reverse takeover of a Amsterdam Euronext listed company, and then we announced also the acquisition of the Bitcoin Amsterdam conference. So yeah, we're super excited to be launching our European Bitcoin treasury company.
I had the pleasure of speaking at the Amsterdam conference last year, and it was definitely one of my favorite conferences and my first time visiting Amsterdam. So wonderful acquisition there. So I'm curious, kind of to get your before we go further on learning about Treasury's kind of roadmap and vision going forward. What your background is. I found it very impressive in capital markets. And obviously you've been a Bitcoin fan for a while, so I'd love to hear about your bio.
Sure, absolutely. So I grew up in Amsterdam, right around here. Studied econometrics, a master's, and then moved to London afterwards. Started working at Goldman Sachs, where I spent time in a couple of divisions on the equities floor, but also most time in the special situations group, which invests in distressed assets. And basically, I spent most of my career in distressed assets at Goldman, then at Fortress, then at Halcyon, where I set up the European securitization platform, and then I ran my own fund for a while. And basically, during the time I ran my own fund, that was post financial crisis. That's also when obviously the central banks were printing money like there was no tomorrow. So I really saw firsthand that debasement and the inflationary environment we're in with zero interest rates essentially. And that's also the time when I got into Bitcoin. So the last 7 years or so, I've been in a variety of called digital and traditional roles. The last few years, I was at a large London-based hedge fund where we became the largest creator in FTX and one of the largest in Genesis as well. And then earlier this year, I saw obviously big opportunity in the Bitcoin treasury space with the success of the MicroStrategy spin-offs like Metaplan, et cetera. And decided it was a great time to really be launching one in Amsterdam at sort of, where the first stock exchange was and the first joint stock company. So that's where we are. That's sort of how my background led into where we are now.
Given kind of your extensive experience in financial markets, a question I've heard that is really interesting is why are there Bitcoin treasury companies, but not, for example, gold treasury companies or other types of companies that would accumulate assets using that same kind of approach of intelligent leverage?
Yeah, it's a very good question, actually, very interesting. If you look at how sort of gold developed from a store of value and sort of a base, and obviously being used by central banks for a long time, and then being kind of hard to access for individuals, especially to access, and even for institutions, where it then moved to ETFs in a variety of ways. And that sort of got sort of stuck there, right? So gold ETFs are the easiest way for investors to access gold. I think the unique thing about Bitcoin in itself is obviously we've gone through a super accelerated time frame, right? We've Bitcoin's been in existence for 15, 16 years, as opposed to thousands of years, and it became digital gold very quickly. And now it's unmistakably digital gold and digital energy, which is super exciting. And in that process, we've seen so much innovation in different ways, right? We've seen this Bitcoin itself, transactions, the whole digital asset ecosystem around it. And this capital market innovation, to me, has really been a seminal moment for the asset class. And then the way that it was really the first way for investors to access Bitcoin in an equity format, right? It's the first the Bitcoin treasury companies, obviously MicroStrategy, was the first equitization of Bitcoin. And because the regulation wasn't there for ETFs, et cetera. So it's really first, and it sort of stuck there and was able to grow in that sense. I would think that's, in my view, the main reason is sort of a regulatory called almost like an arbitrage. It's sort of the order of priority. I think for gold, one big element of the reason it exists for a Bitcoin treasury company is this arbitrage, as you mentioned, the securitization of Bitcoin, the financing, the growing through equity issuance. And that model doesn't really work for gold, given that even if you look historically and you're going forward, the rate of return, i.e. the cost of capital, is much lower than Bitcoin's. So because Bitcoin has a certain expected rate of return, it has a historic rate of return, which, as we know, is somewhere in the 30s. It allows for this capital structure to be built in this way. So I think that, to me, is the main reason. It's the order, and it's also the way that the financing of Bitcoin works very well. And then on top of that, there's a number of natural arbitrages where in some jurisdictions people get taxed differently if they access the asset directly or via stock. There are some jurisdictions where you cannot access the ETFs, like in Europe, you cannot access the IBIT ETF. So those are all then ancillary reasons why the Bitcoin treasury companies in their equity format became, in a way, one of the dominant forces.
Yeah, that's really interesting. On the path dependency and kind of the history point, Fortress, I remember in 2014 they had Bitcoin on their balance sheet, but it never really metastasized or snowballed into what Sailor did. But that's an interesting historical tidbit. I know you mentioned that you were at Fortress.
Yeah, and obviously, and also we obviously see now also Pete Brigger, essentially CIO of the credit funds, but also the main business, also coming onto the board of MicroStrategy, of strategy now. So it's very interesting to see that come together.
Yeah, it comes full circle. So, when we were thinking about these capital structures on top of Bitcoin, you mentioned too that another big differentiator with gold is the expected return going forward. Gold is very mature, although it's had a great run this year. Let's give it credit there, but that we're going to expect to see more gold mining that will bring more gold supply onto the market, and that will drive down the value of gold relative to its current position, I believe. And you can't have that with Bitcoin. No matter how high the price of Bitcoin goes, they're not going to find more Bitcoin. In fact, that's going to get cut in half. So, do you think that expected return is kind of downstream of the scarcity of the relative scarcity of gold versus Bitcoin?
I think it's that. I think it's also adoption and a change of mindset. And it's slow, and it really depends on where you are and your outlook on different things. And I have many of these debates with my TradFi friends. But the in a way, that conversion from gold being the main store of value to Bitcoin becoming digital gold, and therefore the main store of value, I think it's unmistakable, right? And I think it's one element is, as you're saying, with gold there will be continuing supply. It's also interesting that gold has some sort of use case, right? It's, as we know, it's used in jewelry and different things, which actually makes it a lot less pure as a store of value. It's actually a negative. People mention it as a positive, like at least gold you can use for something. In my view, as if you will, sort of, to find the purest form of capital that will, in effect, be a hedge against debasement of fiat currencies. It's much better for it to be pure as opposed to having that sort of use case. And as you said, being able to be where supply is kind of unknown in a way. So I think that's an important element. And I think the other one is, as we said, is like we are seeing just increasing adoption of Bitcoin as this store of value. Right? We've seen it on the regulatory environment. We've seen an increasing adoption from just the man in the street, and we've seen it for increasing adoption from institutions. And that's really, we're in this super exciting period where that's happening. It's rapidly changing. We see it in the price of Bitcoin, obviously, and it's only going to go one way. So, ask me where is this financial system going to go 5, 10, 15, 50 years from now? It's only one way for Bitcoin, and that is why I think also that sort of point where Bitcoin will start overtaking gold as the largest asset class and as a store of value. That's inevitable. That's going to happen. So
Yeah, so it's really a combination of the supply and the demand differentiators. Where do you think that institutional adoption for Bitcoin is today? I know that there's been a lot of progress over the past year after IBIT, but do you think that there's, yeah, where do you think it is today?
sure. I like to think of it as almost like a matrix. On the one hand, there's by region, and then on the other hand, there's by type of institutional investors, and then in the most basic form, equity and credit investors or fixed income investors. So if you think by regions first, obviously the U.S. is really forward looking and early on the curve with just MicroStrategy having more than 13,000 institutional investors. Right, they report this every quarter. A number of them are probably also international, but the majority will be U.S. I'm always excited when one of the state pension plans or otherwise is reporting MicroStrategy or other forms of digital assets in their holdings, which is also increasing. Endowments are adopting, obviously the US endowment model is very much avant-garde in the world of investing. Very much people follow that model, like the Yale model. So all these things are happening, and that's again only going one way, with US leading the pack. When I think of Europe, right? It is very much slower. In fact, I would say it's almost like the distance is increasing a little bit, unfortunately, between the U.S. and Europe, where the regulation is still slow in Europe, adoption in general, the mindset. But there's definitely some green shoots. And then I would say, if you think about equity versus credit versus fixed income, that is, Spence touched on a little bit. That's a very, very exciting opportunity, I think, globally, but especially for Europe. So obviously, again, Michael Saylor really changed the market with the pref securities he's been issuing over the last year or so, 4 of them now, and that is not only great for MicroStrategy shareholders because you get essential leverage with no maturity. It's these are perps. It's also an incredible way to get fixed income investors into Bitcoin because the buyers of these instruments now have essentially, they're long Bitcoin through a fixed income instrument. Their risk parameters, they prefer to have a pref at 10% coupon as opposed to sort of the equity risk, but they are in the company, in this case, MicroStrategy, right? So with the European fixed income markets, in essence, the largest in the world, right? Also, Europe, an average European allocation would be sort of 60% fixed income and 30% sort of equities and a bit of the rest, whereas the reverse in the US. That is a very big opportunity for Europe and especially for Treasury, for our company, to address that because we are in Europe. We're also in still fairly low interest rate environment, right? There's about 150 basis points difference between the US and European base rates. So for us to over time aim to offer pref securities or converts to European fixed income investors at a very large premium to their current bond portfolio is a big opportunity, and that is a very sort of natural way to get European investors into Bitcoin. I think if you ask me now, it's probably first through fixed income and then through equity because it's closer to home. But that in itself is still a very exciting opportunity because obviously that capital then flows into a capital structure like treasuries through fixed income instruments, then translate into more Bitcoin purchases. So for us, that is a big opportunity. So to your question, US very much only going one way with this adoption, increasing institutional adoption and investments in Bitcoin. Europe, very early stages, but definitely on the rise. And you also need to show product, right? We need to show attractive product that's well structured in a great company with good corporate governance, good oversight. Those are all the things we also want to build in Treasury, and then make it easy for them to invest in these instruments.
Yeah, that's really interesting. One of the biggest criticisms we've always heard of Bitcoin is that it's too volatile. And I think that on one hand, we as a Bitcoin community want to be defensive and kind of justify its volatility, and that's I think that you can't have great returns without great risk. But also, we have to meet people where they're at. If they don't have the risk appetite to hold spot Bitcoin, then I think that creating products for them that are better than the status quo. So you mentioned rates are low in Europe. How low are they for kind of typical bond portfolios?
Yeah, sure. At 10 years, at 2.5 government risk, right? So it's quite a bit lower than the US, obviously still higher than in Japan. But for a European fixed income portfolio manager to start getting into called high single digits absolute return, you've got to really go down the risk spectrum, right? You really go to high yield credit risk. And we're actually doing a little project on that, on comparing, call it fixed income risk through a Bitcoin treasury company and high yield. I've been investing a lot in high yield space. As you mentioned, distress is in my background, and usually it's high yield bonds that sort of break. And to me, that the moment we get sort of rating on Bitcoin Treasury fixed income instruments and can compare it to ratings of high yield bonds, that'd be super interesting because it's actually much lower risk than a lot of high yield bonds. So yeah, I think that is a big opportunity in its own. And then the whole world is looking for yield, right? Looking for good, for high risk adjusted yield. And I think we can offer that through the Bitcoin treasury system. And to your earlier point, you mentioned is like, as you say, everybody finds their own risk reward parameter. And it really reminds me of a securitization. As mentioned, I set up a multi-billion dollar securitization platform where you really strip the asset side into different tranches. And ideally they're rated. If you can get them rated, and the ratings requirements mean that these different tranches need to abide by certain constraints, then you can really get really attractive pricing. Actually, that is a massive opportunity, and I think we're not there yet, but I think to me it's inevitable that we'll be sitting here a few years from now where these well Bitcoin bonds will be rated. So
Yeah. So now on that question, it's really interesting. Today, when I look at the dividend yield on MSTR's preferreds, which seem to hover around 10%, and then I compare that to how over collateralized they are, it seems to me at least that these are mispriced. That these are, the yield is way too high, and that it's due to maybe how early we are, that this is the first year that they've been trading, and so eventually we'll kind of see the spreads tighten. But do you think that the rating agencies will kind of follow the price and try to attach ratings that are based on the price, or do you think that they'll have a first principles method, or go look at the collateral and have a methodology that is not market driven so much as actually assessing the risk?
yeah, that's a great question, and it's obviously a bit of guessing how the range agents will look at this. I don't think the only way is to essentially structure a bond together with range. Get them involved from the first moment. That's like on the CLO side, right? When you structure CLO, you bring them on board almost immediately. You got your model, your sensitivities, constraints, and they can sort of fix it. I think it'd be much harder to now say, hey, this is strife. How would you rate it here? I think it's very difficult. I think you got to bring it on from the beginning. But if you do, I think they'll stick to first principles, right? Which, as you say, is collateralization, different constraints around the instruments, and then you can optimize that. And I think that is the big opportunity. And then obviously, as you mentioned, interesting, you're talking about 10% for each prefs. So there's two ways to look at that, right? If I compare to Europe, if you think about the spread over base, that is probably called 6% or so, 5.5, 6%. If we can get the same in Europe, it would mean that the actual instrument would be lower, right? We're talking about 2.5 plus called 6 or so. So we're talking 8.5. So if we can get 150 basis points lower cost of capital, cost of credit capital in our treasury company, that would be very interesting for shareholders. So that's one thing clearly we'd hope to aim once we get to this stage. I think the second way to think about it is that this sort of as you said, this 10% is quite high on a risk-adjusted basis. And again, if you start really compare it to high yield bonds and the default rates there, so once we see more history on default rates and everything around it, I think it'll become more clear to investors that these are actually mispriced, as you say, and the spread should come in, which is great for shareholders. etc. So we're really hoping to see that. And as you all say, we're still early on this, even though there's billions now outstanding in pref securities of MicroStrategy. We're still early. I like to compare it to the pref securities of banks, right? That's where Europe is kind of avant-garde. Europe's always had this regulatory framework where the banks need more and more tier one capital to support their leverage essentially. And for typically European bank pref, we're also talking high single digits, but those instruments are like easily, you know, 15 times levered, right? It's super risky, right? The moment something goes wrong, there's something you saw with Credit Suisse, those get impaired immediately. And you really need a lot to happen on the Bitcoin treasury company before they get impaired. So I think that part, the stress testing, different scenarios, I think that will be key part to get rating agencies to adopt ratings for treasury bonds.
And how do you think about kind of the appeal of prefs for retail investors versus institutional portfolio managers? Do you think that there will be particular avenues that make more sense in different jurisdictions, or is it about marketing and kind of getting the word out there?
Yeah, I think as Michael said, obviously called stretch is a sort of iPhone moment because suddenly you compare you are indeed a retail investor or even institutional, but you sort of think like, okay, I got some money that I like to keep liquid, but I want to put it somewhere. I can put it in a Fidelity account or my bank account. We're talking low single digits, and suddenly there's this instrument with the same features that gives you this double digit yield. It's crazy. So I think for especially retail investors, it'll be very interesting going forward. I think that also transcends to Europe and other markets where that should be very appealing because it's so easy to compare, right? Talk about short dated, compare it to everything else you have out there. For a retail investor to buy, a pref with perpetuity, it's a bit harder to sort of. It's a new kind of instrument, so you need that sort of almost like slow starter problem of showing them how this instrument works over time. But the beauty of the short dated one is you can really immediately compare it to the alternatives that are out there. So that's why it is probably the most interesting instrument actually. The stretch short dated credit that sort of it has a floating rate, right? It will always sort of try to price at 100, and the coupon adjusts, so it prices at 100. And I think for certainly for individual investors very interesting, but actually also for institutional, right? If you're again a fixed income portfolio manager, whether you got to manage your cash or you want to sort of get some high yields, it's so that's why I think there's a big future on it. It was a big IPO, very successful, and see where it goes from here. But then again, as I said earlier, right, you always got to make sure that leverage and the same clearly we're very focused on that stays in check versus the Bitcoin balance and your market cap. So you're kind of limited in a way by your Bitcoin growth, right? By your treasury growth. If you manage to grow that through share issuance, through other means, through the credit instruments, you can keep growing that debt issuance with it. But you shouldn't overstep that, right? Because you also want to be have a good capital structure and be positioned for more volatile times.
Yeah, and so looking historically, Bitcoin's had some big drawdowns and lots of volatility. How do you think about the leverage ratio? What is there an ideal number? Does that number change over time, just depending on market conditions?
Yeah, I do think that number changed over time. I think the number will go up, frankly, right? With volatility. Bitcoin as an asset, you mentioned volatility earlier. Bitcoin, one of the beauties is it is a volatile asset, right? It's, volatility is part of its attraction. Volatility, interestingly enough, has come down a bit, right? We should talk about last weekend a little bit, but in general, it's come down, which means that with the underlying asset class being less volatile, leverage could go up a little bit. We're still very much in the camp of being conservative there because you want to be able to withstand different market environments. I think actually the way that strategy does it is actually a good guideline, right? They're sort of in the 20% range if you include both converts and the pref securities, probably a bit below actually, 15-ish. And they've grown it sort of slowly over time. They're the biggest by far, right? The 800-pound gorilla. So they, if anything, could probably send a little bit more leverage. So I think that's probably a good guiding principle. And for us, we would again take a very prudent approach, and we grow that with time.
Do you think that the future cycles are going to reflect Bitcoin's historical performance, or are they, as you mentioned, going to be lower volatility? But are they going to follow that 4-year cadence that we've seen with the halvings?
Yeah, that's one of the key questions. So a couple of
Yeah.
observations. So I think when I think about, I don't think the expected return of Bitcoin is. Still very excited about that. So I think in that sense, we're still very bullish on Bitcoin's longer term path. I think there's a couple of things that are happening in tandem, right? So if you look, for instance, last weekend, let's talk about it for a second. We saw a very intense bout of volatility for a short period of time. You've seen, right, almost 20 billion of liquidations, probably estimates are even a bit higher in 24-hour period, the largest ever by a multiple. What I do think is very interesting is that despite this, the recovery was very swift. I think Bitcoin itself has within that been quite the outperformer and stabilized. And I'd like to think that actually Bitcoin treasury companies are a constructive factor in this now this within all these stakeholders. And there's a couple of reasons for that, right? One, obviously, what we've seen is liquidations both on in DeFi protocols and on centralized exchanges, and mainly with with perp trading with high amounts of leverage on positions. And that's totally fine. That's part of the market. But Bitcoin treasury companies don't do that, right? We don't take margin positions, and we don't take bets. In fact, on we don't do trades, right? We just accumulate Bitcoin over time. And so, if you think about it, about 5% of all Bitcoin is now being held by Bitcoin treasury companies, obviously about three by MicroStrategy. This is in a way in itself a stabilizing factor. You have a fairly large component of the market that is not on margin and is never for seller. And secondly, obviously I come from the hedge fund space. As a hedge fund manager, you're always in a way managing your risk for, to put it bluntly, for your monthly performance, right? You never want to show a bad monthly number, or at least you want to limit that to your investors. And even though you may not have margin loans on, you may still de-risk because you're like, well, I want to cut my losses here and de-risk the portfolio, make sure my own volatility, my own returns gets dampened a little bit. So you get this, and we've seen this time then. We saw it in 08, right? In the GFC, we saw in sovereign debt crisis. We've seen in 2020 Corona at the beginning. You see these very, very quick deleveraging, de-risking by all market participants, right? By traders, by market makers, and also by hedge funds. And here you are again. Bitcoin treasury companies don't have that. We don't have this monthly sort of requirement to report numbers to investors. We don't have redemptions, right? If people say, "Oh, you lost so much last month, I'm going to redeem," we don't have that. We have very stable capital. We have permanent capital, and we are long-term holders of Bitcoin. And those two things, no margin leverage, and two, being in essence long-term holders and literally never being forced to sell, is a huge stabilizing factor, right? And I think that is what we've seen as well in last weekend. And then going forward, I think this will only increase, right? We're all building increasing Bitcoin balances. I think they will be constructed for the ecosystem. The fact that there are a consistent buyers of these, including us, long-term holders, does take supply off the market, right? It only increases demand, but it takes supply off the market, and that's in itself a dynamic which is obviously fantastic for the Bitcoin price. So while again for these very intense short bouts of volatility, I think this is a stabilizing factor. I'm not at all meaning that this is going to dampen price going forward. Actually, so that's those are actually, I think, very good dynamics, and something that also is very much a constructive element that Bitcoin treasury companies are building and are bringing to the space.
So on the equity side for Bitcoin treasury companies, that if we model it as a leveraged Bitcoin equity, do you think that that's going to take demand away from these perp markets of that have that cascading liquidation issue? That traders are going to learn a tough lesson here, but that ultimately there's a better product for them in the future of when these companies are leveraged, that they're going to trade like amplified Bitcoin and have the the, the the properties that they're looking for. Although obviously they won't be 40x long Bitcoin, But the even if you think about it from a brokerage account perspective, that maybe it makes more sense to go leverage long on call options, for example, than even on perps market. How do you think about the competition there for leveraged Bitcoin equity?
Yeah, sure. I mean, I think there's two sides to that, right? I think on the one hand, I think people will be taking a step back a little bit after what happened last weekend with, as you said, all the leveraging, everything else that happened around it. I think that is definitely a case for trading either cash or through options in a Bitcoin treasury company. On the other hand, the market's always there's always going to be, in essence, traders in the market, right? Traders will trade. They'll want that sort of, I guess, extreme outcomes, and that will always stay in the market. And I think we've seen it more in crypto in general than in other asset classes. It's a whole new generation of high octane traders. I think that will continue to last, and that's part of the ecosystem. That's totally fine, and it comes and goes. We all saw that. We all thought that post FTX, this market would take years and years to recover. It was back pretty quickly in the end, with people going in again. So the cycles are so short, so powerful actually, that I think it will last. And again, it's part of the ecosystem, so we all take our little part in it, and it's all constructed for it. So
When we look at kind of the financialization of Bitcoin, there's been options chains on MSTR, on IBIT. Do you think that is there that same kind of culture of options trading in Europe as we've seen in the US?
yeah, massively. The options market we're quite early in Amsterdam here, so a lot of the called original market makers are actually from Amsterdam. That are also in Chicago, so very much an active options market. And there's a fast track program on the exchange to get your options chain listed above a certain market cap. So we're very much intending to have the options chain as soon as we can, because it really helps, right? It helps the liquidity, it helps your converts, it helps everything around it. There's interesting stats though, because the options volume on MicroStrategy is double the size of the combined options volume of the top three contracts in all of Europe. So it gives you a bit of an idea that this is a very attractive feature of a stock of a Bitcoin treasury company, which is very much lacking in the European market, right? Because on average, European companies are a bit more called industrials, called more traditional markets, less tech, less growth focused, where the US market has that. So in the US, MicroStrategy is the third largest trade option contract after Nvidia and Tesla. But in Europe, it would be by far the largest, right? Again, it's double the size of the top three contracts in Europe. So I think that's a big opportunity, actually, a real opportunity for Treasury to offer essentially this high volatile stock, and therefore an options chain which people can really trade and create vol. So that's really exciting opportunity set, actually.
And do you think that eventually all these derivatives are also kind of reducing volatility in the sense that you have a lot of people that are selling volatility that ends up suppressing and kind of changing the price path for Bitcoin compared to what it has been in the past, to that going forward, Bitcoin's price is going to be um, a lot different and in my mind at least better to have high steady returns than higher volatile returns.
Yeah, no, I'm in essence, I really grew up as sort of a markets guy, like a free markets guy. So the more liquidity you have in the markets, and it goes for both longs and shorts, and people be able to express any view, and as many instruments as possible, as long as they're well structured, as you say, calls, puts, and buying, selling, everything, the better. The better, the more you get price discovery, the more accurate price discovery, the more liquidity, and that is just really great for the ecosystem. And I think it's interesting that with these Bitcoin treasury companies, you got the two assets, right? You have the stock itself, and obviously, again, the MicroStrategy options contracts are massive, but you can also, in essence, take a view on the underlying in one go, or you can hedge one versus the other, which is why the convertibles issuance has been so interesting for MicroStrategy. So I think in itself, first of all, it's great for the market to have this, and secondly, I think we've seen, certainly, as I mentioned, Bitcoin volatility come down a bit, right, in last year or so. I'm not sure. Probably it's exciting to see if it had to do with MicroStrategy, options trading, and everything around it, but it could be some correlation between the two. So I think in general, I think it is a positive, right? we're talking about Bitcoin maturing over time, as long as we still, as mentioned, have these very interesting demand dynamics going forward, with a more stable path, that's in general good for the asset class. I agree.
So kind of changing gears a little bit, on Bitcoin treasury companies, we've seen a big debate about the importance of the operating segment relative to kind of the financing and investing side. Um, what's your view on what the operating company should be contributing to the overall treasury strategy?
Yeah, it's a great point. I think for us, we find it very important actually, that's why we purchased the Bitcoin Amsterdam conference, right? So that's a very exciting asset to have. It contributes to the ecosystem. There's education, bringing community together. It's also being hosted next month here in Amsterdam, and we're bringing top speakers from the whole world to the city. So I think that's a really good asset in terms of contributing and building the ecosystem. At the same time, it's also an attractive asset for us to have, in terms of spreading the word about Treasury, right? We are hosting the conference, so it's that sort of marketing flywheel, which is important for a Treasury company. Get our name out there, get people to have a positive association with it, and that's very important itself. If you then think about other operating businesses, right? In general, more on the media side, there's a Bitcoin magazine. There's merchandise we're doing. I think all these things are important for a treasury company. That's certainly our view. I agree. There's different takes on this model, if you will. The way we're approaching it is very much that the operations, as long as they are in the Bitcoin ecosystem, are very much a contributing factor. So that's for us a key component.
So we've heard people say like you need to have a manufacturing company that has lots of free cash flow that's going to provide kind of the engine to pay, for example, the yield on the preferreds, the dividends. Do you think that perspective has merit, or what are the limits to that?
Sure. It's funny because if you take a real step back, right, about what does a management of a company to do? What does a CEO of a public company to do? And I've obviously been on the other side, being an investor in these companies. In the end of the day, it's really about allocation of capital. And allocation of capital is in a day itself a function of return on capital employed, right? So CEO's decision, he can build a factory, he can buy another company, he can return money to shareholders by buying stock back. What should he or she do? Well, it should be the one which has the highest return on capital. And that's something very basic, but sometimes people forget that. I think both investors and management teams, frankly. So in the example you gave, at the outset, I would not be in favor of that, because to have a factory that spits off cash flow, you need to invest in that factory. I need to buy it, or it takes up capital. And it's very unlikely that the return on capital of that investment is higher than owning Bitcoin. So I would always opt for it as an owning Bitcoin. And I think it's that's one important reason. I think the other reason is that it's very much, I think from an investor perspective, the easier to understand, the cleaner the company is to analyze, the better it is as well, and the better it is for your own multiple, etc. So I think you want to try to optimize around it, giving it a very clean story for investors, the equity story. And then the last component, it is obviously important to be able to pay your interest, right? And there's different theories about that. Obviously, one way could be to say, look, are if your leverage is say 15%, and let's say on this 15% your average rate is, let's say, 10%, right? Maybe a bit high, then basically you need 1.5% every year of your Bitcoin balance that you need to pay in interest, right? 15% leverage on your Bitcoin balance, on your Bitcoin NAV, 10% interest is 1.5% per annum. So that is not unachievable, right? Either you should be able to raise it in equity or other ways. In ideal world, you can also optimize your Bitcoin and, in essence, use it as a productive asset in a very, very risk averse way to generate some income on your Bitcoin. And there's obviously a number of ways you can do that. You can do different option strategies. There's some staking. There's a number of different things people can do that. And we're actually exploring those opportunities. But obviously, the key thing is extremely risk averse, because it's very asymmetric, right? I've been from a credit background. The problem with credit is your upside is 100 cents and your downside is you can lose everything, and what you can make is 8 or 10% on rice is small. And it's the same with these projects. If you start using your Bitcoin as a productive asset, you're trying to make a bit of money to pay for these interest costs. But if you lose money on that trade, if it does have to be at an FTX or another counterparty that loses money, then your business could be gone because people won't trust you anymore. So with that in mind, again, it's a very high bar to do that, but we do think there are ways now that Bitcoin, which obviously in itself is not a yielding asset, you're able to generate some revenues on your Bitcoin.
That makes sense, and it's probably one of the most controversial aspects in the treasury space is whether to put it to work or to leave it in cold storage or some mix of the two, right? Um, the on the question of kind of valuation of treasury companies, so when I was learning about securitization, one of the most surprising things I learned was that the equity tranche can actually be sold at a premium, and that means that overall, securitizing an asset or a loan portfolio can create value where it's greater than the sum of its parts. Um, do you think that is what drives MNAV is kind of that premium on equity from its greater risk profile, but also its higher return potential. And what should MNAV be? Should it be 6 or 1.1?
Yeah, no, or 0.9. No,
Yeah.
it's a great question. So again, taking a step back, right? MNAV is like any multiple in the public markets, where it's PE multiple or EV/EBITDA or anything else like that, right? It is in essence a value that the public markets put on a company based on expectation of future growth, right? So if as a Bitcoin treasury company you have proven, or at least you have the expectation that you can create, Bitcoin yield, Bitcoin per share growth, right? You can grow the company in an accretive way for shareholders. Then there's a multiple that the market will assign to you. And that comes back, how do you create Bitcoin per share growth? That is by some leverage, prudent leverage, but some leverage is accretive, right? You start issuing press at 10%, Bitcoin goes up by hopefully a higher number, that's accretive to shareholders. You finance yourself you create a spread, really. And then there's some element which has some reflexivity in it, is that if you trade at a high MNAV, above one for sure, then if you sell shares, that in itself becomes accretive because the shares you sell expensively, right? So in a very strong market, which we've seen the space develop very quickly, right? From only there being MicroStrategy to there's only sometimes at some point being a few hundred if you count other crypto assets. Then that was a very sort of hot summer, if you will. And also, to be fair, post summer, that sort of I would say very exuberant period has come down a bit. So the MNFs have come down, and in my view, in our view here, that's very much a natural progression of the space, but also very good actually. Because the problem is with if you trade at an MNF of 6, unless you're able to issue equity at 6 or higher in the future, or Bitcoin goes up a ton, those shareholders buying on at 6 are going to lose money just mathematically, right? And to be trading at 6 and continue to trade at 6 or higher, that is very, very difficult. You need a lot of things to come together, and it's actually also extremely strong markets, right, which you don't control. So in my view, having a market which is more called disciplined, more realistic. So first of all, it means MNF multiples, which are in a different realm than call it, mid to high teens, and also an environment where not every single coin or not every single team can just go out and raise a public vehicle essentially. I think is very much good for the space. So it's like any of these, everything as in crypto happens much quicker than other spaces. So we've seen it come up very quick and come down very quick. So where we are now is, I think very much also what we actually said ourselves also in meetings and everything 3 months ago is saying, look, there'll be an environment where there is going to be always a set of high quality players that will be able to show Bitcoin per share growth, and therefore will be able to trade at some sort of premium to NAV at a higher. And there may also be a few that are going to be in a tougher spot where the market does not expect them to be able to grow because they're too small, or they've made they've had some problems with execution, and they may trade below NAV, right? And then that's also an opportunity for those first set of players to acquire the second. And then the question is, obviously, as you mentioned, like what does constitute a player that trades at a good premium and can grow? We think there's a couple of elements, right? There's one, have a vision that is high conviction and strong, and also that sort of, I guess, the market agrees with. There is team, and it's both executive and non-executive. So you need to have a really strong team that can execute well, with capital market experience and market experience. And actually, in Treasury, we like to think we have both in house. We're very excited about that. And also good corporate governance, right? A strong board, that can oversee, be a sounding board, etc. And again, we're very very excited about our board and very grateful for the people who joined our company. And then it's those two things, right? Make sure your execution on the capital side is solid. Being able to issue debt at the right pace, at the right structure, etc. Being able to use the capital markets. There, in that sense, you also, I didn't mention this before, but we're actually the first Bitcoin treasury company in Europe that's on a main exchange, which means that being on a primary exchange, we have all the different tools that are available to U.S. companies at our fingertips, i.e., pref securities, ATMs, et cetera, et cetera. So that's important to do that. And then the last thing is obviously, also on the asset side, making sure you manage them well. Your work with top counterparties, if you think about custodians, and then if that's part of your vision, make sure you also deploy those assets in a smart way. So I think, though, if you get that picture right, and last is obviously marketing, which we mentioned earlier, right? Very important to have that marketing flywheel in combination with the capital markets. If you have those things right, then I think the market will assign you some sort of premium, and whatever the premium is, the market will have to decide. But that's hopefully the case.
That makes a lot of sense. On on the financing side, so we've talked about perpetual preferreds. There's also been other tools that have come to into use, namely convertible bonds. How do you think about the trade-offs between financing with perpetual preferreds versus convertible notes, or even secured lending and other opportunities that are out there?
Yeah, sure. I think um, I think they go well hand in hand in the right balance. So they both have their benefits, right? So what's the benefit of a convert? In Bitcoin treasury companies, because of the high vol, they have 0% coupons typically, right? Most of them do. So that is great. So you don't have to worry about the cash flow. And then in essence, you've sold an option for the buyer of this converts to buy your stock at a premium, right? So that in itself is very accretive to shareholders, because you're not paying anything to have this instrument going, but you may sell them your stock in the future at a premium to the current share price. So that's in a accretive. What you don't want to have is your entire debt stack be comprised of converts, because then most converts have some sort of collateralization covenant. So, for instance, if you've issued, say, 200 million of converts, you need to have 4 million worth of Bitcoin at any point in time, right? So then that's where leverage ratio comes into effect again. If you had, for instance, 20% of your Bitcoin NAV in converts issuance, then at the moment that it says 20%, if Bitcoin is down 60%, then you get to that breach, right? Because then you also need to have 40% in essence in collateral for your 20% converts. So that's, we know these cycles. That is then pretty this gets very close, so probably not a good idea. So then, if you combine that with pref securities, where the benefit is they never mature, you don't have any covenants on the Bitcoin, but you have a 10% coupon, for instance, then that's a very very healthy balance. So then, on average, the two mixed, your cash cost of capital goes up, obviously, versus just converts, but then you don't have this maturity profile to manage, and you don't have this collateral that you need to worry about in a way. So I think that's the way you, as an issuer, allocate between those two converts, prefs. Hopefully, at some point there'll be sort of a called normal bond structure. If you think about normal companies, investment grade bonds, than high yield bonds and then sort of hybrid instruments like converts, pref securities. That'd be obviously fantastic if you can build up that way. Secured lending, um, yeah, I'd be a lot more cautious with that because that's definitely with that's like margin, right? It's definitely with the direct covenant. You got to have 50% loan to value. If it doesn't, you have to fund more. That becomes much more of a short-term funding instrument, and that comes back to the earlier discussion of then you may be for seller because if Bitcoin drops in price, either you got to fund it or you lose your collateral, right? And um, so I think that the beauty of these other fund structures is at least on conversion you have a maturity, at least you're a bit more it's more stable. So in a volatile asset class, it's kind of important to have a stable debt capital structure.
Yeah, that makes a lot of sense. And then on the equity side, I think that a tool that's been very effective, but yet controversial, is the pipe investments, where it's essentially a race to get to scale, um, and that I'd be interested to hear your perspective on kind of the value of moving quickly to scale up versus the pipe mechanics, which can be sometimes hard for folks to understand compared to just the normal ATM process.
Sure. Yeah, look, the way that most Bitcoin treasury companies have gone public is through either a pipe deal into a public company or a reverse takeover with a pipe, right? So it's just a pipe or a pipe plus a reverse takeover. So in our case, what we've done is it wasn't technically a pipe, but it's kind of similar. It was a private investment round with a reverse listing into with an existing listed vehicle. So so that's sort of if you think about the way to get listed, that is pretty much the only way. So you raise money from a private investor base and then go public. Um, and I think what we've seen in practice happen is that sometimes that process of getting regulatory approval, registration of the shares, etc., took quite a long time. Talk about months and months here, right? In some cases. And in the meantime, the private investors are sort of they're sort of locked up there. They can't do anything. It's a private investment. They knew that. But then the moment that the everything unlocks, you see a lot of volatility in that stock. And we've seen it a couple of times now. And so you kind of see the situation where a public company announces, say, a pipe deal plus a reverse takeover. So that stock itself becomes subject to a lot of trading, and people get very excited about it. So they start trading at very high multiples. The implied MNAVs are then way too high, right? Unsustainably high, sometimes 10, 20, etc. So you see that sort of share price movement, and then this pipe unlock is starting to happen, and a lot of shares are coming to the market, and we've seen it happen, and I think we've sort of I think the market's learning from these things. These are all new instruments, as in new structures, the way it's happening. What we saw when we structured our deal in the summer is indeed some of these unlocks being kind of lead to a lot of volatility in the stock. So we actually put, and this is all in a public announcement, we put locks on our anchor round investors. So they have an unlock schedule where they unlock over a couple of months. So that sort of stages the if you want to exit, that's obviously a good right, but it stages it. And we were very fortunate that our investors all backed this structure when I proposed it to them. And this is still from in the summer, so in sort of July, August. So I think that's one thing we've learned a little bit. I think the kind of unique thing, and again, there's many unique things about Bitcoin treasury companies because we're all developing the space together. It's a new space. Is that these pipes were oversized versus the existing market caps, right? A normal pipe would be, oh, a company has say $1 billion market cap, it wants to do an acquisition, it's not so sure about the public market, so it goes to a round of private investors as this private round into public equity, right? Pipe. And but it'd be like a 200 million pipe round. But here's the opposite, right? You got a market cap company of 20 or 30 million, and you got a pipe of 500 million, right? So it's like, and that is that balance can lead to some sort of, I think, sometimes unforeseen consequences actually. So I think it's all part of the called growing pains of the industry for us. And I think also with as mentioned earlier, right? This we discussed about the MNAVs. as the space is becoming a bit more called normalized, a bit more of a stable, in a steady state, if you will, in terms of the MNAT, in terms of how investors look at the space, realistic expectations, right? People shouldn't expect, immediately a huge multiple, right? It's long. Hopefully we're in for a long game. At least we are, right? So once you get it back online, then I think we're only stronger in this.
And then on the question of scale, how to be able to access convertible bonds and to be able to issue perpetual preferreds, what size do you think a treasury company needs to be in general, in the case of treasury?
Yeah, it's a great question. If you think that, I'm not saying this is the number, but if you think that, for instance, a MicroStrategy, let's say between 15 and 20%, so if you think that that's sort of a yardstick, if you will, then you probably need to be, for a convert that's really sort of for instruments that are more widely traded, probably high hundreds of millions of market cap, and maybe towards a billion of market cap, right? At a minimum, right? I mean, certainly smaller companies can do converts, but they're usually private converts. But that's an active market. That's we're also seeing that. That's not a problem. But at the end of the day, where you can really grow is a convert that has, an ISIN, is tradable on Bloomberg, is trading on exchanges. That's what you want. And the same with the pref securities. So again, this is one where as you grow, and we're going through that same process, you start with private rounds, a pipe, private converts, some private sort of credit instruments. And as you grow, you can do more broadly placed and more widely. But I think for that latter, somewhere towards a billion is probably the right number. Because then people have liquidity, right? People always want liquidity.
Yeah, that makes sense. Um, so going into winter here, typically on the 4-year cycle, Bitcoin goes parabolic in November, December. Is that your read on the situation, or do you qualify it with some uh, other factors?
Yeah, no, I'm very bullish. And so you asked earlier about the 4-year cycle, actually. So whether it's broken out, et cetera, it probably links to this question. I do think we're seeing a bit of a different market environment. So a couple of the elements we spoke about today, right? Increasing adoption, strategic reserves, countries doing it, Bitcoin treasury companies rising, rates being very, very low, and inflation being high, right? So this whole hedge element, people sort of saying, look, I need to not lose money on my savings, becomes more of a prevalent theme amongst any investor, right? And that's something that's really worrying if you think about it. So I think all those elements are really setting us up for a very strong period of Bitcoin growth and frankly price appreciation. Where it really breaks free cycle, who knows, right? I think there's a good chance it may to some extent, as in we won't see this deep bear market again, because I also think that the last few real bear markets we've seen, there was some real external events into it, right? Now we've seen a massive external event last weekend, and we're still sort of recovered quite well. So that says a lot for the strength of the market right now. So I don't think, in my view, the rate environment we're in, the sort of macro environment we're in, really are affecting the price yet. So I'm really bullish into Q4 for sure.
Spencer, did you have any questions before we wrap it up?
Yeah, King, I want to take it back a little bit to Europe's fixed income market. You mentioned that it is larger than that of the United States, and I'm curious if you could help our audience understand why that is. What are some of the structural drivers? And following that too, I kind of want to get your take on how you see that evolving in, I guess, the shorter term. I know we've seen the euro strengthen year to date against the U.S. dollar, but would love to unpack kind of the macro side of the European investing environment.
Sure, absolutely. Yeah, no, it's a great question. So I think to begin with, Europe has very much has a fixed income mindset and culture, where the U.S. has an equity culture, right? If you think about Warren Buffett, they always said, "Look, why would I ever own a bond? I want equity." So that's very much ingrained, which is just part of the different structures we're seeing. And the other thing to note is that Europe, the pension market is a very important component here. It's very developed, right? Netherlands used to have one of the largest pension funds, and after being overtaken by the U.S. ones, but it's very much also an important one, where in essence the government takes care of your pension. It manages. You don't decide your own. The government manages all of that. So that's sort of part of the structure here. And those two combined make for a big fixed income allocation, because all these pension funds, they allocate very risk averse. They don't think like an your university endowment. They think very risk averse, very often the boards of these are comprised of, the underlying stakeholders. So APG, the largest pension fund, the largest in Europe and the largest in the Netherlands, it represents the for instance, the teachers. So there's a teacher on the board, etc. So it's very much that culture. So all of that leads to massive fixed income allocations, which is why this market is so big here, right? And that goes from both government bonds and corporate bonds. And then we come back to the earlier points. A lot of these pension funds have actually deficit sounds a bit heavy, but they're below their rate to basically be able to fulfill all the liabilities. It's usually between 5 and 10%. What they call the surplus is a negative 5 to 10%, sort of just below. It's not nothing disastrous. They'll survive, but it's like they gotta really focus on generating enough income to pay all these liabilities. And as you know, we have also an aging population in Europe, right? So, this generation needs to really be paying for more and more people that have worked very hard and will be taking their pensions and probably live longer as well than the last generation. All great things, but has a financial consequence. So on the one hand, fixed income culture in terms of investing, much more than equities. But on the other hand, more and more requirements to fill those liabilities. And that leads to a hunger for yield, right? A hunger for yield in a lower rate environment, which is how we got to talk about why if you offer a fixed income instrument through a Bitcoin treasury company that offers a yield well in excess of other comparable fixed income instruments, that'll be a very attractive opportunity. And we're talking about, really the euro-wide market. So not just the Netherlands, but also Germany, France, et cetera, et cetera. So 450 million people. That is really a big opportunity, and again, also mixed with sort of also somewhat lower adoption here. And then I know you asked about fixed income, but it made me think of one thing is I also generally believe that a treasury company like our stock, once listed, will be a very attractive asset to the market. If you're a European portfolio manager, which I've been, and you're looking for either Bitcoin exposure or you're looking for, some sort of alpha in there, then a stock like Treasury will be a very attractive asset, right? Because you can actually get real performance with that. It's the European equity markets in general, as mentioned earlier, they lack some volatility. We're talking about very much names like Shell, Royal Dutch Shell, or Glaxo, or Unilever. They're great companies, but their return profile is very different from a treasury company. So if you're a European institutional PM, you cannot buy an ETF. You can only buy on a main exchange. There's literally no way at the moment to get Bitcoin exposure. So that's a real product market fit.
Yeah, and another question I have on the European market is the regulatory side of things. I think you mentioned Metaplanet early on, and something that was a tailwind for them was this regulatory arbitrage and just the tax treatment around owning Bitcoin outright versus owning equities. And that was something that I think many people noted as being an attractive value proposition. Do you see any parallels in terms of the European regulatory market as it relates to securitized Bitcoin products, and would welcome your thoughts on
Sure.
Europe's regulatory landscape.
Yeah, I would say the biggest regulatory advantage that a Bitcoin treasury company now has is that for a individual right now, it's, as mentioned earlier, it's impossible to buy the IBIT ETF. So if you want in your stock trading account, your called Robinhood equivalent app here, you want to get Bitcoin exposure, and your entire portfolio is in euros, so you want a simple euro exposure, hit buy, and you got it. It's actually impossible to do in European on the main exchange, right? So that's a real product market fit. That is, I would say, the main thing. This tax arbitrage, there's a few countries where there's some of this. A lot of regulation is changing now, so there's some quirks, but not as sort of I call it simple as in Japan. So I think the advantage we have is the time zones, right? You can just trade in your own time zone, your own currency, and just easy access to Bitcoin, and hopefully also an asset that it at least has a target of outperforming Bitcoin through the mechanics that we discussed earlier, right? Through leverage, etc. So amplified Bitcoin exposure. So that is, and again, for a variety of regulatory reasons, actually, there's some ETFs we don't have access to here in Europe.
Got it. And I think my final question is just kind of if you could provide context on the fiscal health of Europe. As I mentioned, the euro has been strengthening of late, but would welcome your thoughts on how do you think about European bond yields, sovereign bond yields going forward, and that as that relates to European fiscal health.
Unfortunately, it's not great either, right? We're also having deficits here. We in Europe we fought in a way the same path that a lot of governments did global, a lot of central banks did globally. Lots of money printing post GFC, and also enormous money supply growth post 2020 COVID. So we're in the same camp. I would say a number of the European countries are also I guess having their own struggles, whether it's with divisive party base, with budget deficits. That's all happening in Europe right now. So we're in the same camp in that space, in that sense. So that's even more of a reason for strength of Bitcoin in the ecosystem, because it's very much the stable factor within this a bit of uncertain times on that side. All right, we have also obviously the war happening on the in Russia Ukraine for a number of years, happening on our borders. So all these things happening in there, where we're I guess all facing a bit of uncertain time at a geopolitical level. Combine that with big money printing, that's another thesis for Bitcoin. It's interesting that euro's been so strong this year versus the dollar, right, which you refer to. And I think that's a bit of a combination of probably a bit of an overdue correction. I think the euro and dollar. I mean, I'm not a fixed income FX trader, but I thought it really went out of whack quite a bit, actually. So to me, it's a bit of a correction, which got exacerbated with some of the U.S. policies. So to me, it's say I'm personally not actually believe. I know some people are like, "Oh, this is not the time to buy euros because the dollar is only going to weaken more." I'm not sure about that, because the reality is all the fiat currencies, they're all debasing against Bitcoin, right? And whether between them there's a bit of variation, that's not going to rock the boat too much. I mean, 5 or 10%, it's massive in the FX scheme. In the grand scheme, it isn't. It's all going to be massive against Bitcoin, which is the key in my view.
Yeah. My point of view is that the value of these fiat currencies will ultimately reach their cost of production, and reach that equilibrium ultimately. And I think the timeline for that is really the big question. And not I suppose like a doomer myself. I think like many folks, amidst this gold rally, they say, oh, the fiat currency complex is breaking at the foundation. Not necessarily my point of view, but I do think that like when you measure, the euro against the dollar, you've seen this relative strengthening. But when you measure it against many other commodities, we've seen this massive bull market over the last 3 to 8 months or so. And I think that backdrop for Bitcoin is extremely compelling when we're looking at other commodities and commodity monies in comparison to Bitcoin's valuation. So very, very curious to see where that goes.
100% agree. Absolutely.
All right, gentlemen. Well, thank you for joining us so much, today. I think that it was a great conversation, and that we'll have you back on soon. And I think that it's really great what you're building in Europe. So thank you for kind of spreading the Bitcoin message out there.
Appreciate it, Pierre and Spencer. Thanks a lot. Great. Thanks for having me.
Thanks, Spencer, for the excellent questions. And thank you to the audience for listening, tuning in. Please subscribe, leave us a review, and where can people follow Treasury's journey?
Sure. It's on our X is Treasury_BTC, and on LinkedIn the same. So yeah, love to have you follow us.
Excellent. And if anybody has the opportunity to make sure to get to the conference in Amsterdam, that's going to be a great event. So thank you for hosting that.
Absolutely. Thank you.